this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Of course, we did do a webinar last week, edition ahead of the historic Fed meeting and that we today. Well, so let's have a look at the disclaimers. Just a couple of key webinar. We do markets these fundamentals, looking at the technical moves in markets, stocks or commodities. Objective. We also want to break down all jargon and complexities that you read about. So if you do have any questions, please do ask them along the way, and we'll try and answer as we go, at least at the end. Web. It's just after 11 a.m. in London. I'll just run through then what we hope the next 30 minutes. We'll just switch it up and we'll go straight to last week's event. We did CPI data and also the ECB meeting, of course. We'll then get into the heart of the webinar, which will, of course, the preview of the main event, that Fed meeting, of course, and also there we also have the Bank of England meeting, those on Thursday and Friday, and we'll look at all the associated currency made around those meetings, and if we have doing some of the data out this week that we've seen. Okay, firstly, we'll go straight to last week's main event, which was US inflation data. We'll look at this and then look at the dollar index after this, as well as then reviewing the ECB meeting, as I say. There was also bits of UK data last week as well, important. And even this week, we had a Canadian CPI, which we'll briefly touch upon to look at dollar CAD. Before then, looking at the Fed meeting, of course, and we'll look at stock market indices as well and the technicals around those and what may happen on the Fed meeting. But US inflation first, of course, key number for the Fed, although, of course, they have moved their sort of focus towards now employment data for sure, which is, of course, part of their dual mandate. Officials really being more convinced now that inflation is heading in the right direction, of course, towards a 2% Fed target. Before they can focus now, especially on those employment figures and away from CPI. Of course, that doesn't make the data that less important, of course, and we had an interesting set of figures, actually. Core CPI month on month was hotter than expected, as it came in at 0.3% versus the expected and previous 0.2%. The unrounded figure actually 0.281%, reflecting really upward surprises in shelter and transport services, and more precisely, actually, the contribution from owners equivalent rent, OER, which rose to the highest level since January. The core year-on-year, that was in line at 3.2%. That was expected and previously as well, printing. And then the headline month-on-month, that was at 0.2, which was expected, unrounded 0.187%. And then the headline year-on-year was slightly softer than anticipated, printed at 2.5%, 2.5% versus an expected 2.6%. Really, it should be noted that the shelter CPI, that lags changes in the actual rent real estate market by around 10 months or so. And that really implies that this really shouldn't be seen as a sign of re-accelerating inflationary pressures. And that really means the fundamental story of sustained disinflation does remain unaltered by this inflation report from last week. Also, interestingly, the pickup in the core index, which is the key number for policymakers, that was driven by components that have a much smaller weight in the Fed's favored inflation gauge, which is the core PCE deflator. and they are also sourced actually from the PPI data. So it seems really inflation still has a little bit of work to do to hit the 2% target, but really, as I say, labour market conditions, labour market data, more important now, getting more focus from Fed officials. That was the CPI data. Then we had also the ECB meeting. As expected, they cut rates by 25 basis points to 3.5%, and then they narrowed the gap actually between the deposit rate and the main refinancing rate as flagged in March. Really, in the policy statement, then the ECB reiterated that they would continue to follow a meeting by meeting approach and remain in data dependent mode. That's exactly what we said and highlighted in our preview last week. New growth and inflation forecasts barely changed from June. Again, we highlighted that last week. Although the core was upgraded, that's core inflation number was upgraded by 10 basis points due to stubborn services inflation. So just something of note there, but otherwise a sort of copy and paste, very similar forecasts. Interestingly, during the press conference then, President Lagarde offered no guidance for the remaining 2 policy meetings this year. And really that was a simple copy and paste from Q3. Which suggests really skipping the October meeting, the next meeting, and then potentially reducing rates by 25 basis points again when we do get more growth and inflation forecasts, which are of course available on a quarterly basis. So that means the next one's available in December. Also, we should highlight really, we think it is a short 5-week intermeeting period up until the next ECB meeting, October 17, that is, with only one more CPI report and one more PMI survey figures. So that really being another reason why they skip October. Although, as we say, the ECB president really didn't give us any guidance at all about what was to happen going forward. Lagarde, though, she did acknowledge that inflation dynamics would accelerate going into the year end. Because of energy-based effects. Basically, we saw huge drops in energy prices in Q4 last year. So all in all, really, money markets didn't really move that much. They slightly reduced the amount of cuts into the October meeting. I think now around 7 basis points of easing, so around a sort of 28% chance of a cut in October. Much less likely, really. And really the bank is assuming a data dependent approach, and as we put here, a meeting by meeting stance really. We did get, actually, we should say, some of the sources stories we get after the ECB meeting. Those are basically the hawks and the doves trying to sort of reassert their positions. Bloomberg sources, they noted ECB officials haven't ruled out a rate cut at the October meeting, even though that's unlikely. And then we had a Reuters story noting that, well, an October rate cut is unlikely. Move before December would take exceptional negative growth surprises. And the sources really said it was unlikely to see an October move. And really, they'd rather wait for a new round of projections in economic projections by the staff, that is in December. Pretty much what we said, and nothing really untoward there. If we just look at euro dollar actually now, and I'll just pull up this chart. Firstly, in euro dollar, which you can see here. You can just see, yeah, last week then, minimal move really. We did get an uptick and then sort of closed very marginally lower. But then from Thursday onwards, big jump higher and yeah, move progressively higher since, sort of bouncing off around the 110 level. We do have back here the late December high, that's at 111.39, just capping the upside at the moment, capped up the upside before, and obviously we broke higher just to 112, but then found pretty strong resistance there as well, although we were, you can see, overbought on the daily RSI. So we just pulled back just below that first fib level, below the 50-day moving average. Let me just check. That is the 50-day moving average, 21-day moving average actually. So just below that, and then we're just tracking above it now, but below the 1139 level. 112 strong resistance. Otherwise, an initial support probably 110.62 and then 110. Okay, that is the ECB meeting. We did have a couple of data points out of the UK last week as well, but I'll get to those when we look at the Bank of England meeting. As I mentioned as well, we had some Canadian CPI data actually out this week. We should mention, quite important, of course, for the Bank of Canada, and we'll just touch upon that shortly. And I'll just pull up actually a dollar CAD chart for you just to see how that is going, how CAD is working against the dollar at the moment. Just on that inflation data out of Canada, though, prices, they rose 2% in August versus a prior 2.5%, and consensus expected 2.1 actually, and they fell by 0.2% month on month. That was a prior 0.4, and the consensus unchanged actually. So a weaker than expected inflation print and report really that has led to some market speculation that the Bank of Canada could be in for a 50 basis point cut at its October meeting. Remember, already we've seen quite a few 25 basis point cuts from the Bank of Canada already. At the policy announcements actually earlier this month, Governor Macklem said that the central bank must increasingly gauge against the potential of inflation falling below target due to weak economic growth. And markets, well, they still price in a bigger probability of a 25 basis point cut, but actually the probability of a bigger 50 basis point cut rose to around just under 50% actually for the next meeting by the Bank of Canada. For the CAD then, dollar CAD, this is of course had that big move down in August after that spike high at 139.46, got down to 134.36 or so. Decent support there, you would like to think. And we've just got now through, and we're trading around the 200-day moving average. So that's that black line, 135.88, really driven by, of course, what the Fed does now, of course, in a few hours' time. Upside resistance, probably 136.31. You can see that fib level, which just capped that top side last week after the CPI data out of the US. That was a high of 136.22. So sort of resistance around that level initially, with the next level for us just below 137. If we do get dollar selling and then the dollar CAD, well, could be interesting because of obviously potentially what gets done by the Fed, and then the Bank of Canada, of course, will follow in October. Support then for us 135.56, probably that near-term minor fib level, and then you've got the 21-day moving average just below that, 135.42. Okay, let's get to the main event, of course, of this week, and that is, of course, the Fed. Here's a graphic. Hopefully you like these, which prove of some use just of the main numbers, the economic numbers really, and potentially what to look out for, what the Fed's looking at, of course, guiding their rate decision. We finally got there, we would say, the 18th of September being marked on our calendars at least for some while, this Fed meeting, historic Fed meeting, as I say, because of a first rate cut since 2020. There's so much debate really around a 25 basis point cut, of course, or a 50 basis point move now. That all follows, of course, Chair Powell's speech at Jackson Hole, where he basically noted they will not tolerate further weakness in the labor markets. Investors really then focused on, as I say, employment-related data, and then the size of rate cut bets were really on any signs of softness. Of course, we got the August non-farm payroll report, which kind of wasn't as weak as expected. Unemployment declined slightly. Of course, we got the 142,000 headline print, and we had big downward revisions, but there were many thinking that that would print sort of just above 100,000. And really then rate cut bets have yo-yoed. That's the phrase we're using. After that non-farm payroll report, they only saw money markets a 30% chance of a 50 basis point cut. Since then, well, they came down even further after that CPI data we just talked about, to around 15% only, 15% that is, for a 50 basis point cut. That was last week only. But then since then, OBS are climbed and climbed. Certainly since it was kind of a concerted sort of media reports put out there from the Financial Times, from other Fed whisperers like Greg Ip, like John Hilsenrath, and then of course from Nick Timiraeus. He's the kind of the current Fed whisperer, if you like. So the guy that has been sort of tipped off when the Fed is in blackout period. So that's 10 days before the announcement. So last Saturday, they went into blackout mode. So we didn't hear from Fed officials, and yet the Fed have used certain people to guide their message. At the moment, that is presumed to be Nick Timiraeus, as I say, at the Wall Street Journal. He basically said over the weekend that this week's decision was a close call. The Fed had a dilemma between a 50 basis point cut or not, or essentially a 25, and that really fueled speculation around this bigger reduction. Odds now sit around 60-65% in favor of that bigger cut, with then a smaller cut less fancied by money markets. I should say the consensus for Wall Street analysts is certainly very much swayed towards a smaller cut, a 25 basis point cut. So as you can tell from what I'm saying, a lot of speculation around this, and that will be a key move and a key driver for volatility in markets, of course, with people really undecided on what will happen. For us personally, I guess it is pretty poor communication by a major central bank, and certainly the Fed, to go into this pivotal meeting, historic meeting, as I say, and markets still torn between either the size of the rate cut, essentially. Of course, for this meeting, we do get quarterly economic projections and also the dot plot. The 2024 median dot plot is, well, I'll just get to the June dot plot here that you can see, and that's really showed only one 25 basis point cut for this year, 100 for next year. Pretty much expectations, consensus see 2 to 3 25 basis point cuts, obviously depending on whether they go 25 and 50 in a few hours time. That, of course, signals the dovish shift, and then focus will be on 2025 as well, with a faster pace of cuts potentially indicating more recessionary fears potentially. There's so many moving parts to this meeting, and obviously the release of these projections and dot plot that, yes, volatility will be very high, very choppy, really, price action. The Fed, well, they will potentially well, they'll aim for gradual adjustments. Potentially, that was the thinking last week anyway, all to revolve around evolving inflation and employment conditions being key, of course. If the dot plot and Powell suggests fewer basis points worth of reductions this year than the current, well, 115 basis points expected for by the market for, with the Fed easing this year, remembering there's only 3 meetings left. This one and then 2 more, and the market's currently expecting 115 basis points of easing, 115 that is. So potentially, if he suggests fewer basis points than that, and the dot plot as well for this year as well, then the dollar should go bid, and they're really being confident that the economy is not headed for a recession, may keep risk appetite and stocks therefore elevated. Even if this means sort of fewer than expected rate cuts. The dollar would certainly probably gain on a 25 basis point cut, as money markets obviously don't see that as likely at the moment. But really then it would come down to the press conference Chair Powell's press conference, he has been dovish in all of those this year, and certainly then if we got only a 25 basis point cut, he would probably strive to be very dovish, and we would get choppy price action in the dollar, potentially going higher initially on the disappointment, if you like, of just a 25 and not a 50 basis point cut. But then obviously Powell would potentially highlight and really emphasize that the Fed would go larger going forward. Of course, then that also depends on the dot plot and what that shows us for this year and next year potentially. So many moving parts, as I say. If we just look at the dollar now, and before that, I just breezed past actually this, which just shows you obviously where we are at the moment, 5.25 to 5.5%, and then around 115 basis points of easing priced in for this year alone. Before then, another 100 or so for next year as well. That would take the Fed funds rate down to 3% or so, and then just looking further out, if you think the neutral rate, because we're obviously in highly restricted territory at the moment, but the neutral rate is around 2.8% now. That shouldn't be changed. Expectations are for that to stay at that level. So you just think about that wider sort of perspective for the dot plot for next year as well. If we just, as I say, go to the dollar index now, just bear with me 1 second, and I'll just pull that up. This is, of course, the dollar against 6 of its major trading partners. I always say this, but it's worth saying again, the biggest weighting in this index, don't forget, is the euro with about a 56% slice of this index. You can see, again, fascinating levels we're at now, just at this very strong support around 100.61. That is the low from late December. Yep, late December, of course, and we bounced off there a couple of times. You can see quite a few times, and we're just hovering above it now. The 21-day moving average, initial resistance potentially 101.21, and then the sort of first minor level, fib level, that is retracement level, is at 101.88. What we would say probably, I think a lot of traders I speak to, professional traders that is, really saying that there is so much priced into the curve this year and next, really, so much dovishness priced in that really it's a very high bar for Powell to sort of jump over that and possibly take the dollar lower in the initial sort of stages or after the release of the data and possibly the press conference. That's kind of what I said earlier, but obviously this being a very strong support level, we would need something substantially dovish to take us through that, you would think, a very strong dollar selling. If we do go lower, then of course we look at levels again, which are probably around the sort of July low, the July 23 low from last year, which is at around 99.58 or so. And then if we pull it back, we're going lower again down to sort of below 99. But that's our kind of thinking on the dollar at the moment. So much dovishness priced in. If they go 50, of course, then potentially we get a knee-jerk reaction. And then it will depend on Chair Powell's press conference, of course, and then the dot plots as well. But again, there is the thinking as well as that we may get a sort of buy the rumor, sell the fact sort of move. We move lower on expectations then of a big sort of rate cut and potentially dovishness. But if we don't quite get that, then bang, we bounce off this level again. And as I say, 101.21 initial resistance, and then sort of 101.88 cap the upside. You can see over the last couple of weeks being sort of stronger resistance. Okay, let's now get on to the Bank of England's meeting, of course. That is on Thursday, tomorrow. If I just pull up another graphic, hopefully you like these, as I say. Not much expected really from the Bank of England, actually, after probably the fireworks from the Fed. Rates expected, the base rate expected to stay at 5%. Vote probably likely to be 7-2. Remember, it's 5-4 last time, a rare 5-4 that is. So 7-2 likely this time. Ramsden and Dingra probably going to vote for another rate cut. We don't get any press conference. We don't get any updated MPR, so monetary policy report. So just be the statements released at midday UK time, that is. So could be a quieter affair. Since the last meeting, of course, and that rate cut, the data basically sort of corroborating the bank's stance. So PMIs sort of beating expectations in both July and August. Labour market continues to improve gradually. Average weekly earnings, they continue to slow, although they are stickier than expected. The year-on-year rate actually for July, just for your guide, at 5.1% still, so still sticky. And then we had today's, of course, inflation data. The headline, that stayed steady at 2.2%, so rebounded from sort of 2% in July last time around and stayed steady at 2.2 this time. The core, though, that did edge up actually 1/10 higher than expected to 3.6% from 3.5%. And then crucially for policymakers, it's the services inflation number, which is the key number. And that stubbornly stayed, well, ticked up actually to 5.6% from 5.2%. That was predicted though, but interestingly, there are some elements in this services inflation which are potentially not as important and temporary maybe for the Bank of England going forward. Otherwise, yeah, we've had GDP, well, that was flat actually, but is expected to remain positive for Q3. All in all, well, Governor Bailey actually, he himself said at Jackson Hole at the end of August, the bank really not in a rush to cut again, and that really prompted markets to factor in a strong chance, really around 75% or so for no action this week at this meeting, really. As I said, no press conference, so won't be really any guidance from Governor Bailey on that front. Otherwise, pricing-wise, markets, well, they expect probably another 2 quarter-point reductions in November, December. There is around, yeah, as I said, around a 28% chance actually of a move at this meeting on Thursday. That was actually higher ahead before the CPI data out this morning. But otherwise, yeah, fully priced for November rate cuts and then a high chance of one in December. Obviously, if policymakers maintain that sort of no rush mindset, then the pound really should be underpinned with support, could extend its latest rebound. If we just pull up the cable chart then, which I'll grab now. Just bear with me 1 second. The cable obviously sterling against the dollar. And let me just pull up that chart here. Decent run actually, and another pickup today as well. You can see the 200-day moving average, that black line really just helped to support really in early August when we got down below 127. Since then, jumped to sort of 132.66, 132.61 is now sort of resistance to an upside move. You've got the 21-day moving average just to support there, that blue line, that's at 131.45. And then decent support below at 130.37. You can see that capped the upside in July and then acted as support earlier on this month. So those are the levels we'll be looking out for. Again, expect choppy price action certainly this evening over the Fed meeting and then possibly over the Bank of England meeting, although possibly not too much volatility. Otherwise, we do finally get the Bank of Japan meeting. That's on Friday, early morning UK time. Just double check you can see that chart, which you can. Yeah, Bank of Japan. Well, if you remember, of course, July, they raised interest rates by 15 basis points, 1.5 that was, probably higher than the 10 basis points expected, and have been since signaling really more hikes are looming, with markets pricing in a very, very high chance of another at least 10 basis point hike by the end of the year. No further policy normalization expected on Friday, but Governor Ueda is likely to maintain a relatively hawkish tone of gradual moves, which we've heard in previous press conferences. And we've had, of course, several Bank of Japan members indicating their openness really for further rate hikes if the economic outlook remains aligned with expectations. And if you remember as well, after that August sort of volatility at the start of August on that first Monday, Bank of Japan officials warned that obviously they wouldn't really look at doing any policy action changes during volatility, but now we've calmed down, and therefore potentially they do like to surprise actually, but at the moment nothing expected for Friday, but certainly action expected later on in the year. Regarding the yen, of course, although Bank of Japan officials have been repeatedly noting the pace of rate hikes will be slow, of course, we've seen this divergence in monetary policy strategies between the bank, of course, and the rest of the central bank world. That has led, of course, to a surging yen, and in certainly dollar yen, we've seen that 161 and above really, that high, and then a really strong sell-off in dollar yen. So the yen appreciating, of course, surging and hitting, of course, recently 140, below 140 that we got on Monday, 139.57 that low. So a multi-month low, of course, as really traders abandoned the previously overcrowded carry trade. That is, of course, where traders were borrowing in yen and then investing in other higher yielding currencies. Of course, now that yield differential, the difference between interest rates, really, that's what that means between the US and the yen, is obviously narrowing somewhat substantially. As I say, the focus though for the meeting will be on Ueda and colleagues really continuing to signal more hikes down the road. Anything corroborating the market's view that another increase could be delivered before year end may allow the yen to continue appreciating really, and dollar yen sliding. We do have this really big level for us. If we just show you what we're looking at here, this is a weekly chart, and you can see this long-term Fibonacci level. So from the 2023 low up to this year's high above 161. Key long-term fib level is the 61.8 retrace level. You can see it held prices back in December, and we're sitting on that level now. 140.48 is the level there, which is key support for us in dollar yen. Otherwise, if we do go lower, then we've probably got these swing lows here at well 138.05, and then probably from July last year 137.23 to look out, but again that's very strong support for us at 140.48. We should say, nationwide CPI data out of Japan on Friday as well. That's just a few hours ahead of the Bank of Japan meeting, of course, and their decision. Japanese core nationwide CPI expected to tick up 0.1% to 2.8% from 2.7%. This comes after Tokyo CPI released at the end of August. That surprisingly printed hotter actually than expected, 2.4 versus 2.2 expected. Okay, we will wrap it up there, I think. Really, really good to have you on the webinar. Really do appreciate your time. I don't see any questions actually, which is a good news, hopefully, and everything has been clear. As I say, great to have you on the call, and we do have another one actually next week. We've had a 3 in a row actually. As I say, it's normally bi-weekly every other week, but this month with everything going on, we've got 3 this week, so 1 next week as well, where we'll definitely be reviewing all the price action and all the fundamental news, obviously from the Fed, from the Bank of Japan, and the Bank of England as well. And we'll just see what is going on there. Actually, just before I wrap up, something I haven't done, which is look at stocks. So just briefly, apologies, I said that I would look at stocks, just obviously ahead of the Fed, which is obviously crucial. So let me just pull up that chart. Again, this is the S&P 500. Really interesting sort of reversal. If you remember, if I just pull up the weekly chart, you can just see that big sell-off really a couple of weeks ago, and then we've had the big bounce again, and really consecutive days of buying. If I just show you consecutive candle count here, which is what you see. We've had 7 days actually of consecutive buying. The SP up over 4%, I think, and obviously printed an intraday high just in the session yesterday. Not a lot to say really, I guess. In this, we're up those very close to those highs, 56.69 in the S&P. We're not overbought, strong bullish momentum, but we did just pull back slightly. Really fascinating for us that we are kind of, contemplating rate cuts when we're at all-time highs. Of course, in stocks, there's kind of a very odd situation in a way. So again, that's sort of a signal potentially for a pullback if we're not as dovish as expected by markets. Interesting. The Nasdaq has also bounced, but not as much as the wider benchmark index. Tech is struggling slightly, and we are seeing a sort of a wider breadth of stocks moving higher. Certainly, consumer staples, they have led the charge recently, actually, in the wider index, I should say. If you think of names like Coca-Cola, Colgate-Palmolive, Procter & Gamble, they have outperformed that blue chip S&P 500 in the 6 of the last 8 weeks, actually. So really interesting, and that's why we've seen then the wider index move higher, whereas the Nasdaq, the tech-dominated index, of course, this is just struggle more with mega cap tech stocks, of course, as well, struggling additionally. So you can just see of this sell-off, we've moved above the halfway point, but we're just at the 61.8 retrace there. You've got the 21-day moving average at 19,315, and then we're sat on this sort of 19,444 level. Resistance above, just below 20,000, and then, as I say, initial support at 19,315 with the halfway point of this move at 19,862. You can see the difference, though, certainly with then the Dow outperforming the Nasdaq, really switching that up from the last few months, really years of tech-led outperformance. You can see we made I think 2 consecutive record intraday highs in the Dow, and not much else to say. We're not overbought, but obviously we made that new high. That's at 41,835 in the Dow. Okay, I will wrap it up there now. Again, thanks so much for having me on the call. We do have one next week, same time, so we look forward to speaking to you then. Take care, definitely around this volatility of around the Fed meeting for sure, and we'll speak to you next week.